All right, infrastructure. Want to move into it? Let's move into it. So there's not really a whole lot going on yet, but apparently, according to Senate Majority Leader Chuck Schumer, apparently they could have something on infrastructure by July 19th. Now, I doubt it. I doubt it. Apparently, Congress is going to come back to session on Monday, and they're going to finish out the month of July, and then they're on a recess in August, and they come back in September. So they're going to try and push through two bills, a reconciliation and a bipartisan bill, in less than 2 weeks, and then come back. It's not going to happen. I called last week that it's not going to happen until after the August recess, and that's probably what's going to happen because Democrats are fighting amongst themselves on the pay-fors for infrastructure. Now, I'm going to say it one more time. I'm going to say it every time I talk about infrastructure. Why are we arguing over how to pay for infrastructure? Somebody please answer me that question. Why do you need to pay or have solid pay-fors for infrastructure? Because infrastructure pays for itself in the long run. It is like an investment. And if you do it properly, you will see a significant return on that investment. Okay? Anyway, as of right now, there is the plan to pay for the infrastructure is new deficit spending, leftover COVID and unemployment money, a rise on corporate tax, investing with private partnership, and asset recycling. Okay? Now, I have a few complaints about those, but we'll get to those in a minute. Some Democrats also want to add a tax on capital gains and a more aggressive tax on capital gains. There is some pushback in the House about using unused money for unemployment benefits because, according to The Hill, the U.S. is still down about 7 million jobs from February 2020. And there were a few congressmen who were saying that they don't believe the federal unemployment dollars that we've allocated for this extra help during the pandemic should have been used or should be used so quickly. They were thinking that it would be used slowly over time to start building back these jobs because, according to The Hill, we're still down 7 million. But a lot of states have begun to roll back the federal insurance because, whether it be for ideological reasons or economic reasons, states believe that they don't need that extra money because they're starting to see an uptick in jobs. So there's leftover funds. What to do with them? Let's invest them in infrastructure. I don't necessarily agree, or I don't necessarily disagree with that if you can show that the jobs are beginning to come back. According to The Hill, we're still down 7 million. Maybe we shouldn't use that money yet. Don't know. So there's bipartisan pushback, though. There's both sides are pushing back on the investment in the private sector. So they're saying $100 billion would be generated. Negotiators say would be raised by creating direct pay municipal bonds. And I don't really understand what that means because I'm not a finance guy, but the way I understand it is a subsidy or a tax credit equivalent to 35% of the tax rate on the specific bond. So that hopefully would attract more investment from private infrastructure. Now, I don't know if that's going to work. I don't know how that works. We'll have to see. But where I take issue is asset recycling. What does that mean? Essentially, asset recycling means the federal government, instead of investing the money in fixing infrastructure that we either don't use or is broken down, they're going to sell it to the private sector. Now, it doesn't sound like quite a bad idea. They're going to make a sale, which means incoming funds for the public treasury. But when you look deeper into it, it's not that way. This is going to create an opportunity for private equity, hedge funds, and Wall Street billionaires to purchase things like airports, dams, highways, things like that. And we all know what happens when private equity gets involved in these kind of things. They jack up user fees and they can avoid public oversight, ultimately hurting the poor and working class. I want to tie this together with a piece by David Sirota. It's a long one. It's a doozy. Read it if you can. I'll put a link to it. It's a long piece. It took me. I'm not the best reader in the world, but it took me a while to get through it. Essentially, and it ties together with the infrastructure plan, but it's a circle. So bear with me here. Essentially, public workers, so firefighters, teachers, police officers, sanitation workers, public transportation, for the federal government, for state governments, for municipal governments, all the way down, have pensions. Okay. Now, my generation and the generation above me really doesn't know what a pension is. So if you're under the age of 40 and you don't know what a pension is, you've heard the word. Essentially, it is a retirement account that you get through your employer, and you pay into it, and you're supposed to trust the pension manager of wherever you are to invest that money and give you a return, so when you retire, you have money to live on. Worked really, really well in the 50s and 60s. My grandparents and other people's grandparents that I know of are living right now off of their Social Security check, which every person over 65 gets, and their pension fund. But that is going away because of the fact that pension managers are giving pension funds to corporate Wall Street banks, private equity, and hedge fund managers. Now, we saw in 2008, not quite old enough to really remember how devastating 2008 was. I was 10 years old. But the way I understand it is, a large part of it was these greedy Wall Street assholes who were selling these shitty mortgage bonds, these C-rated and lower mortgage bonds that were wrapped up with a bunch of other C-rated and lower mortgage bonds. And there were so many of them in the bond, so many mortgages in the bond, that they looked and they could disguise them like A-level or AA level bonds. So they look like you're investing in quality bonds. And they sold thousands of them, thousands, to these pension funds and other investors and shit like that. And when the bubble popped and the market crashed, the housing market, the pension funds went out too. That's what happens when you let greedy billionaires play with other people's money. And what David Sirota points out in this long piece is there's about $5 trillion in public pensions. And about $1 trillion of it has been moved to alternate investments. Alternate investments include private equity, real estate, hedge funds, etc. And the pension funds are relying on these alternate investors to give them quality returns. But with the quality return come very large fees. And these fees can be set at any level that Wall Street wants them to be set. There's no oversight on that. In a lot of instances, he points out in the piece, in Ohio, it's estimated that Ohio pension funds pay about $400 billion in these fees. That sounds insane. So I'm going to pull up the article because I want to know if that's real or not. I can't remember. Okay, million. I'm sorry. That sounded crazy. Some teachers' pension funds in Ohio are paying more than $460 million in fees every year. Now, you're saying, okay, well, if they're paying that much in fees, what's their return like? The returns are shitty. According to David Sirota in his piece, the returns are often less than a low index stock fund. So a relatively safe, no risk stock fund. You know how that works. No risk equals reward, but not a very big reward. And that's to be expected if you invest in one of these low index funds. Well, the pensions are investing in these alternate investors, private equity, real estate, hedge funds, because those are supposed to be the investments that blow up, that make you big gains. But what these investors and private equity firms are doing is they are cracking up the fees so high that in a lot of cases, municipal and state pension funds are paying more in fees every year than they are seeing returns. How does this tie into infrastructure? With the asset recycling. What these funds are going to do, and these private equity managers are going to do, is they're going to take the money that they get from the fees that they collect on these shitty trades with other people's money. They're going to use that money that they get from the fees, which he points out in the piece, there's a tax loophole where because the money that they get from the fees are having to do with, let me read the wording out. Let me read the wording. Individual wages, there's a billion. Okay, so it's called the carried interest tax loophole. So it classifies, because of this loophole, the carried interest tax, because of this loophole in our tax code, it classifies those fees as capital gains, meaning, rather than regular income, meaning it's taxed at a significantly lower amount. So they're paying insufficient taxes on these fees, and they can set the fees to whatever they want. Again, how does this tie into infrastructure? Asset recycling. There's a provision in the infrastructure bill for asset recycling. So these hedge funds, and private equity firms are going to take public pension money, the fees that they collect from the shitty trades, and they are going to purchase public funded infrastructure. How do we pay for infrastructure? We deficit spend, in my opinion, because it will, in theory, boost the economy more as a return on investment. Well, it won't do that if we allow this type of behavior. If we allow these hedge fund managers and these private equity assholes who have more money than they know what to do with, more money than any human could ever spend in a lifetime. They're taking these public pensions, they're charging them astronomical fees for shitty returns. Then they're taking the money that they get from those fees that's barely taxed, and they are purchasing public infrastructure from the federal government. They're purchasing airports, highway systems, they're purchasing dams, and all this sort of stuff. What are they going to do with that? They're going to raise the user fees, and they're going to avoid public oversight and make even more money on our infrastructure.